You want to lose money trading options? Use the wrong order to get into your trades. It's that simple. As an options trader, it is crucial that you have a good set of mechanics for opening and closing your trades. So in this video, we're going to talk about the different order types that we use most often when we place our trades. And we're also going to discuss some of the potential risks and rewards with each type of order. And when you understand the different order types and how they work, you actually can make sure that your option strategies are executed in a way that's going to minimize risk and maximize your reward. And as we get started here, make sure you hit subscribe and that notification bell. Be really great. Help us keep producing this content. So when it comes to trading options, there's a variety of different order types that you can use. Each one is going to have its advantages, it's going to have disadvantages. And it's really important that you understand the difference of these. Okay, some of the most common types, limit orders, market orders, stop loss orders. Limit orders, probably one of the most popular types of orders because they can help protect you from large losses. Really, because a limit order is an order to buy or sell at a specific price or better. So in a buy limit order, your purchase order will execute at the limit order or lower. Sell limit price or higher. So the advantage of using a limit order is that it guarantees a certain price for the security. But the downside is the trade may not even be executed if the security does not reach that price, right? It's going to leave you out of the trade. So oftentimes we're going to adjust our limit price up or down to ensure that we do get filled. Market orders, another popular type. You just buy or sell a security at the best available price when you hit that button. The advantage is they're executed quickly. Downside is you may not get the exact price you're looking for. In fast moving market conditions or really thin markets, you could get slippage on your order and get filled much worse than you anticipated. For example, let's say you place a market order to buy at $50, right? But there's slippage. Then you get executed at $52. Well, depending on the number of contracts that you have, this could really skew your risk profile for that trade, right? Bad fills equal less potential profits. You got to watch out for that. So with the options that are available for choosing how to enter a trade, what makes one that we choose over the other? Simple. Limit orders are always best when you want to control the price at which your trade is executed. So let's say you're buying a stock, for example, for $50 per share. You could place a limit order at $50, and that ensures that you only pay that price or less for the stock. Problem is, there's no guarantee you're going to get filled. If that stock doesn't trade at 50 or below when your order is placed, it's not going to be filled. And unless that stock price drops to that level, you're just sitting on the sidelines. Market orders, well, at the current market price, you can get executed. So if you want to buy a stock for $50 and it's currently trading at 50, you probably get filled at 50, but you could also get filled higher. That's the advantage, right? They're guaranteed to get filled. The downside is you don't have much control over the price. In general, limit orders are best when you have a specific price in mind and you're willing to wait for whatever, stock or option trade, to reach that level before you get your trade executed. Market orders, well, these are best when you want to ensure that your trade is filled immediately and you're not too concerned about the price moving too quickly when you enter. Now, I've used market orders in the past when I wanted to trade to get in on it, and maybe I'm not going to be able to round to monitor the account to see if I get filled on a limit order. Really, this is just the last resort, and that could end up costing you a lot more in the long run. Order types for trades also include day orders or GTC orders, good till canceled. Again, there's advantages and disadvantages. It all depends on your approach. So day orders are available and valid for the day that they're placed. So this means if your trade is not executed during the session, it gets canceled. So for us at NetPicks, we would rather have that order canceled at the end of the day and then evaluate the potential trade the next day. So after all, we had a full trading session, right, to get filled. We didn't get filled. So the situation that created that setup may no longer be in play, right? We may no longer now want to be in that trade. Good till canceled, well, they are going to remain open until they're executed or you cancel them. This means that your trade could be executed at any time, even if the price moves against you. Now, we've all seen days where we get spiked into a trade, immediate reversal. The advantage of GTC is you do not have to keep track of them, okay? They're going to remain open until they're executed or you cancel it. Disadvantage, again, means you may end up paying more for your trade than you wanted to. But depends on your trading strategy. One type of order may be better suited for you than another, right? But it's really important that you understand the differences between them. On a side note, all of our profit targets and all of our stop loss orders, these are good to canceled because we want out of that trade when our preferred price is hit. And very rarely will you get a bad fill on orders to close a trade, but you can when you enter the trade. So now we know what limit orders are. Well, how do we use them? So as with all trading, we want to get the best entry price that we can get. So buying a call option, we want to pay the lowest premium that we can because the seller of that call option, they want the highest price they can get. Our first approach, look at the bid price, the ask price, and find the middle. So this is an option chain for WFC. We see the difference between the bid and the ask price is 20 cents. We would look to set our limit order at the midpoint, and that'd be $5.05. Remember, we've got no guarantee of being filled in this order, but if these options are liquid, there's a good chance that I will get filled. And if we have to adjust up to get filled, we do it in increments of pennies, not quarters and bills, right? Simply increasing the limit price to $5.06 or $5.08. That gives you a good shot at a fill, still at a pretty good price. If bigger jumps in that limit price is needed, maybe we want to skip that trade depending on the risk profile. Piece of advice, don't take your fill prices lightly, because over the months and the years of your trading, bad fills are going to rob you of profits that would be better served sitting in your trading account. Look, being disciplined on how you enter trades, long-term success, it's critical, right? In our opinion, for most traders, limit orders, the best way to go. Day orders, valid for the day they're placed and will automatically be canceled. GTC orders will stay open until they're executed or canceled by you. The advantage, though, of GTC, again, you don't have to keep track of them. With limit orders, look to set the order at the midpoint between the bid and the ask. If you don't get filled, adjust in increments of pennies. Now, you're probably a lot like most people, right? You're feeling a little bit uncertain about trading options, and I get that. Or maybe you're even uncertain whether you should be trading. And trading options for a lot of people can be a little bit scary, right? There's a lot of information out there. So how do you know which sources you're going to trust? Right? Even if you do have a good strategy, it's really hard to stick to it. Those markets are always moving. So this free guide we have, it's called the Dynamic Duo Guide. You're going to get 2 high-performing markets. Plus, we're going to throw in our one-day options trading strategy. Okay, this is free, just so you know. It's just a download. So this means that you can start trading today, exit tomorrow by following a pretty simple plan. Again, like I said, it's free. Just download it. Link is above or below in the description. Make sure you hit like, hit subscribe. We'll talk to you soon.